Good morning, students. Welcome to your business studies class. Today we will be discussing classification of financial markets from chapter number 10, Financial Markets. So the financial market is classified into two categories, money market and capital market. Now, money market is a market for the short-term funds which deals in monetary assets whose period of maturity is up to 1 year, and the capital market which deals in the assets whose maturity period is more than 1 year. And the further capital market is divided into primary market and secondary market. So primary market is when the assets or when the shares are issued for the first time, and secondary market when it starts, when the exchange process starts, then it comes under your secondary market. Now let's discuss about the money market. So market for financial securities with maturity period of less than 1 year. So it is a market for low risk, unsecured and short-term debt instruments that are highly liquid and are traded every day. So there is no physical location by conducted over the telephone and the internet. And the money market helps to raise short-term funds, temporary deployment of the funds. Let's discuss few functions of money market. So this money market is a short-term market, securities with a maturity period up to 1 year. It is a market where low risk, unsecured and short-term debt instruments are traded. It has no physical location, but it is an activity that is carried on over the telephone and through the internet. It enables raising of short-term funds for meeting temporary shortage of cash as well as a temporary deployment of excess funds for earning returns. The major participants of money market are the Reserve Bank of India, commercial banks, non-banking finance companies that is NBFCs, mutual funds and the financial institutions. The main instruments traded in the money market are Treasury Bills, which are also known as T-bills, trade bills, commercial papers, certificate of deposits, etc. The money invested in the money market entails huge sums of money as the unit value of instruments are high. Liquidity, if we talk about the liquidity, so the money market enjoys a high degree of liquidity as they are short-term instruments and are issued by financial instruments, banks or reputed companies. The expected rate of return is generally low as the money is invested for a short duration of time. So these are few money market instruments which we will be discussing. They are call money, treasury bills or T-bills, commercial papers or CPs, certificate of deposits or CDs, commercial bill, trade bill or bills of exchange. So let's discuss these money instruments in detail one by one. Call money. Now, call money is that method by which bank borrows from each other to be able to maintain the CRR, that is the cash reserve ratio. Now, we all know that the commercial banks under the regulations of RBI, they have to maintain a minimum cash balance, which is known as cash reserve ratio. So, if one bank is short with that, so they can use this call money for the short term finance, which is repayable on demand with a maturity period of 1 day to 15 days. It is used for interbank transactions. Now, the RBI changes the cash reserve ratio from time to time, which affects the amount of funds available to be given as loans by the commercial banks. The interest rate paid on call money is known as the call rate, which is a highly volatile rate that varies from day to day and sometimes even from hour to hour. There's an inverse relationship between the call rates and the other short-term money market instruments. For example, if the call rates are high, then the other short-term money market instruments will be cheaper as compared to the call rates. So, if the call rates are high, the banks or the commercial banks can go for other sources, which makes the call money a unfavorable, or we can say a not preferable source of finance. Treasury bills, which are also known as T-bills. Now, a T-bill is basically an instrument of short-term borrowing by the government of India maturing in less than 1 year. So they are offered with maturities of 28 days, 91 days, 182 days, and 364 days. So they are also known as the zero coupon bonds, which is issued by Reserve Bank of India on behalf of the central government to meet its short-term requirement of funds. Now, zero coupon bonds are basically, that means it is issued with lower than the face value and repaid at par. at par. So the difference between the price at which the treasury bills are issued and their redemption value is the interest receivable on them and is called discount. Treasury bills are also issued in the form of a promissory note. They are highly liquid and have assured yield and negligible risk of default because it is issued by the government of India. They are sold to the banks and publics. Now, treasury bills are available for a minimum amount of 25,000 and in multiples thereof. That is 25,000, 50,000, 75,000, 1 lakh, and so on. Commercial papers. It is issued by a large and credit-worthy companies to raise short-term funds at lower rates of interest than the market rates. So the whenever this line comes in the case study that issued by large and credit-worthy companies, then it is 99% it is a question of commercial papers. So what commercial papers are? It is a short-term unsecured promissory notes, negotiable and transferable by endorsement and delivery with a fixed maturity period. It is usually has a maturity period of 7 days to 1 year. The issuance of commercial paper is an alternative to bank borrowings for large companies that are generally considered to be financially strong. So instead of in the large and the credit-worthy companies, instead of taking loans from the bank, they can issue commercial papers and generate funds. It is sold at a discount and redeemed at par. So the original purpose of commercial paper was to provide short-term funds for seasonal and working capital requirements. For example, company use this instrument for the purpose such as bridge financing. Bridge financing is basically that when the funds are used for the purpose of reinvestment, that is known as your bridge financing. Next is the certificate of deposit. Now, certificates of deposits are unsecured, negotiable, short-term instruments in bearer forms which are issued by commercial banks and development financial institutions. These can be issued to individuals, corporations, and companies during the period of tight liquidity, which means when the deposit growth of bank is slow but the demand for credit is high. That means when people are depositing less money in banks but they are demanding more, that means they are taking out their investments from the bank. So that is a situation of a tight liquidity in which the commercial banks can issue certificate of deposits. They help to mobilize a large amount of money for short periods. Next and the last money market instrument is the commercial bill or the trade bills. Now, a commercial bill is a bill of exchange used to finance the working capital requirement of business firms. We all are aware of this term bills of exchange, now which is a short-term negotiable self-liquidating instrument which is used to finance the credit sales of the firms. Now, when goods are sold on credit, the buyer becomes liable to make a payment on a specific date in future. The seller could wait till the specified date or make use of a bill of exchange. Now the seller, who is a drawer of the goods, draws the bill and buyer drawee accepts it. On being accepted, the bill becomes a marketable instrument and is called a trade bill. Right? When the drawer is or when the seller is drawing the bill and the buyer is accepting the bill, so once it is acceptable, it is accepted, it becomes a trade bill. Right? Now, these trade bills we know can be discounted with the bank. Now, suppose the drawer has drawn the bill and on the buy and if he needs money, so he can discount the same with the bank. So if the seller needs fund before the bill matures, so it can discount with the banks. So the moment a trade bill is accepted by the commercial bank and they get discounted, it is known as a commercial bill. So, to recapitulate, we had done today the classification of financial market into money market and capital market, and we had done money market, which is a market for the financial securities with maturity period of less than 1 year. Then we had studied about the functions of money market, that they are short-term instruments. They have no physical location. They helps in raising the short-term funds. The major participants are RBI, commercial bank, etc. Then we had studied about the money market instruments, that is a call money, treasury bills or T-bills, commercial papers, certificate of deposits, commercial bill, trade bills or bills of exchange. I hope I'm able to make you understand the points, the money market instruments. So these are few questions for the recapitulation. Please do it in your notebook. Thank you so much, students.